Yeah, so it was in our small or cash rich small cap report, which was out in December. Yes, it is. Our cash rich report is normally what we'll call it, and that's what I'm going to go with. But we got some questions on it over the last couple of weeks in our weekly chat. So sign up, and you can talk to these clowns every week. It is worth great details, and it's always something worth if you want more details on our coverage, of course, as much as we joke about talking to them. But a couple of follow-up questions, so I thought I'd really highlight it on the show. So AirIQ, symbol IQ on the TSX venture, provides wireless asset management and location services in Canada. The company also develops and operates telematic asset management system by digitized mapping, wireless communications, internet, and the global positioning system, GPS. Its web-based platform provides fleet operators and vehicle owners with a suite of asset management solutions to monitoring, management, and protect their assets. The stock is currently trading at 49 cents in a market cap of 14.5 million, up a whopping 88% over the past year. So a quick look at their last quarter, Q2 23, ending September 30th, so it's shifted a quarter. Total revenue increased 15% to 1.35 million from 1.17 million. Recurring revenue, the great kind of revenue, increased 13% to 1.08 million from 958,000. The company recognizes the recurring revenue as the software service versus the non-recurring is their hardware sales. So roughly in line with growth, their gross profit increased by 14% to 804,000 from 708,000. And net income, unfortunately, came down to 182,000 from 282,000, a drop of 35%. But this is largely due to a significant foreign exchange in the prior year. So hard comparable, since they had just a luck of the draw gain in their foreign exchange in the prior year, and they obviously didn't have that this year. Additionally, the company has a great large cash position of 3 million, or a net cash position of 10 cents per share, which is obviously a great plus. But I will say I couldn't find any potential usage of cash that the management highlights in any of their disclosures. And if we were to go forward with this company, that'd be something we would call and ask them about, because it represents a fifth of their market cap, that being the cash. So in the question, that one of the questions we were asked about is they asked specifically about the taxes boosting their earnings, which that occurred in Q4 of the prior year. So when you're doing a trailing valuation of the last 12 months, you obviously use the end of the previous year when you're in Q2. So that's why we're looking at this financial statement now. So you can see in this that there's a deferred income tax recovery for 2.8 million, which for a company valued at 14.5 million is obviously massive. So where does this come from? If you look at the next to the line item, there it says we can look at note 14. So you end up going down there. You'll scroll down there or Control F, which is a great tool if you're looking at income statements or financial statements of that. So you look at their deferred tax asset, and you can see it's coming from them recognizing previously unrecognized tax credits, which really what that means is the accountants now believe that previously unrecognized tax credits, which they did not previously expect to be used, are now likely to be able to be used. Ultimately, the benefit really just comes down to accounting expectations, which are a forecast, which is why you end up getting these large adjustments, normally in Q4, as that's when they're going through their full year's audited financials, and they'll management will obviously push, we want to recognize this, push our earnings up, make it look good, and then you'll probably have the accountants push back, no, you're being too aggressive. That's normally the case. They want to recognize as much as they can. Not saying like it's bad or anything, it's just the reality. As well, you can see here they have an additional unrecognized differences of 29.6 million, which the company did not recognize during this quarter. You would have that against whatever tax rate for each of the individual items. So it's be around that 26.5% if they were able to recognize all of that. It depends on the line item, as they have different tax rates. So it gets more complicated than just applying a flat rate against it all. But they weren't able to recognize that. That means the accountants weren't able to see, hey, you're going to be able to realize these tax credits in your current state under their current models. So that could end up changing in the future. You could actually have a rollback of their current benefit as well if their outlook changed negatively. So the next part of the question is, how does this impact valuation and how do you deal with that? As far as earnings go, when you want to compare with other companies, you need to at least normalize it a bit, as the large tax recognition for the quarter, if you would want to normalize it as if it didn't exist. Not to say that tax benefits aren't a positive, but it's just for comparative valuations. So if you remove the tax benefit from the valuation, the price to earnings is 17 times compared to the unadjusted PE of 4 times. So that's quite a difference, a 4 times difference, as their earnings were roughly 4 times as big. So with this adjustment, as well as the company they aren't deducting taxes from the earnings. So that's really where you're seeing it. So this would be equivalent to earnings before tax for a company that would actually be paying taxes, as they just lower their deferred tax asset each time that they're, instead of paying the tax or recognizing that on their income statement, instead of just having a lump sum of recognition like you saw in Q4 2022. And of course, you can look at other valuation measures like price cash flow, which in this case is 9 times, but then that can actually be influenced by cash flow lumpiness, which did actually happen with AirIQ. I believe it was in their first quarter. They actually had quite a big increase just because of working capital changes, and you get that quite often in cash flow. That's why it's something which you need to be worrying about when you're looking at cash flow or other valuation metrics. And that's really what the whole point of the accounting system is, trying to smooth that out, so that it can create other issues like you saw here. But for actual commentary on the valuation, it's getting quite expensive, given they've had lumpy growth seen in recent years due to their hardware sales being quite volatile, as well as working off a small base of revenue. So you should expect higher growth when you're dealing with a small base, as one or two sales can increase growth dramatically, versus if you're a multi-billion-dollar company, you need to have that entire force behind it. And that's why you don't see those percentages as often for larger companies, even in the same industry. As well, gross profit isn't going directly to the bottom line, as SG&A has risen alongside revenue. So you're not seeing that hockey stick economies of scale like you will start to see in some nano-cap companies. And that's really what you love to see. But that's not what we're seeing in this case, at least so far. I'm not saying that can't happen in the future, but they aren't seeing that economies of scale. As well, as the company is a nano-cap, the trading volumes on the stock are quite low, even for an individual investor. Some days it actually only will trade a few $100s on its very low end. And then on the bigger days, you might have something like $25,000, $30,000 worth of the shares trading. So obviously, even for smaller investments, you can move the market on your own. And as well as the bid-ask spreads, when I checked earlier, it was about a 5-cent spread, which is about 10% of the stock value, which is quite large. So you really need a price in that liquidity premium into these companies as well. That being said, small investors can potentially use this volatility, as you can, if you're just putting an order in for, let's say, a few hundred shares, you're just taking a toehold into it, you can actually get those filled quite a bit lower, as if someone dumps a lot of shares onto the market, it will shoot the price down. And that's something which is all obvious you want to watch for in these nano caps. So concluding, it's always good to see a nano cap with strong balance sheet growth, but the growth is volatile and it's not quite hitting the bottom line to the degree you would really love to see quite yet. As well, the company is scaling their recurring revenue at about 15% or so each year, which is great to see, but it's not absurdly high, but it's not low either. So valuations are a bit on the high side, I would say, at this time. I would like to see either higher earnings or a lower price to really jump into the stock. As well, don't get sucked in to low valuation. When you look up on Yahoo, Seek Alpha, or any of those other websites, you'll see normally either adjusted earnings, but with these nano caps, they normally don't have coverage, so you'll just see the straight gap earnings. Within this case, you'll be seeing about a 3.9 PE, when it's really just that tax benefit quadrupling their earnings in reality. So watch out for that. But for now, we'll really continue to monitor this company.
Yeah, and I think what you said there at the end, watch out for just looking at the headline PE number that is not adjusted on this. And it's no fault to the company or anything. That's what they have to report. But when you have, a normalized PE of around 17 trailing, and then what's reported at 4, don't buy it because you think it's 4 and growing where it's growing right now. This is again, a good balance sheet, good, has that recurring base of growth. Would love to see more growth. We'd always love to see more growth, but I think it's more fairly valued now than a striking undervalued company. It's certainly not trading at 4 or 5 times earnings. It's trading at around 17 times, 16 to 17 times normalized, and that's about fair value for a company that has a good recurring base, but it's really quite small. Under 6 million in annualized revenues right now. So I think it's fair value, and I think investors have been rewarded in it for over the past year. And I think it's trading about where it should rate at this point. If it became significantly cheaper, maybe we'd look at it. But again, the caveat there would be, you can't buy a ton. Like if we recommended to our entire client base and everybody started buying, it would probably get rid of that advantage right away. So it's one, if you are in our client base, you're watching it and it became significantly cheaper because the overall market was doing poorly and this business continued to operate as it is now and grew at a good rate. It's one that we could look at over the long term. Right now, I think you did a great job summarizing how the company has a tax kind of benefit affecting earnings trailing. That's going to come off shortly. And then you're going to see, the trailing PE be more on a normalized basis.
And you did a great job with the tip Control F or Command F. Honestly, as an analyst, I'm using that like 20, 30, 40 times a day when I'm going through financial statements constantly to help me find things. I don't know how they did it back in the day.
Back in the day, we read reports like
the full
there was no internet, to be honest. At one point,
course,
I'm going to order the annual report.
Yep.
Warren Buffett used to look through
exactly.
literally annual reports. Can you imagine?
Pretty nice.
Crazy,
looking
right?
for specific
lots of paper
keywords
cuts.
or whatnot.
Yeah, it's true. Oh my God, lots of that would be a different process. Although probably easier to find anomalies if you're the one ordering those and no one else is doing it. It's still though, like that's how we find companies today. Like there are still very few analysts really going through like all 3,500 companies in Canada. It is a very scant few that are going through that. Some of them that work for brokerages, big banks, they're going through the ones that need capital, and it's a different process. It's not really to find the best valuations; it's to find the right company that they can make money doing a financing through. But I digress.